Hey guys, appreciate you joining us again. I'm Alex Helton. This is the Alex Helton Real Estate Show. As always, I've got Sam Dahl with me.
Good to be here, as always.
As always. And as always, we have a question to get us rolling. What's our question of the podcast?
So the question that I came up with, prompted by an email I got the other day, is when it is acceptable to begin listening to Christmas music. So we just passed Halloween, early November. For some people, that's the threshold. They basically don't believe Thanksgiving exists.
They're just ungrateful.
They might say it's a day, it's not a season. Other people are like, give Thanksgiving its due.
Yeah.
There may be some people that say, when did I ever stop listening to Christmas music? So for the Helton household, when does Christmas music start to show up?
Oh man, might be different for my wife. It depends whose car you're in, probably. Yeah. I would say after Thanksgiving. I give Thanksgiving its due, but having Christmas music on while the family is over hosting Thanksgiving, totally acceptable.
Yeah.
In our house.
Yeah.
And the Dahl house, what is it? You guys is there a radio station that just plays Christmas music like 365 days a year?
No, man. I'm not much for, I'll say, the holly jolly Christmas music in general. So I prefer more like a Christmas hymn style of Christmas music.
Oh.
And that.
Nice.
I will on and off listen to occasionally, honestly, throughout the year.
Okay.
But as far as like dedicated Christmas listening, it's usually after Thanksgiving.
Okay.
I think part of it is related to like today it's going to be mid-70s.
That's a good point.
Maybe it's coming from Minnesota and my childhood. It's hard for me to get in the Christmas mood when it's 70 degrees outside. So
that's fair.
I'm generally a wait a little bit guy.
Good deal. So there you go.
What are we talking about today, Alex?
Today we're talking about, today is the recording for the November market update in Davidson, Williamson County. So we'll be talking about what happened in October in real estate in those areas.
And we've got the last 3 months up here as well. So, we've said before, month to month is probably going to get whiplash if you're hanging on the edge of your chair for what happens each month, and you're going to experience emotional ups and downs that aren't fair. Yeah. So taking a broader approach, but tell us what happened, last month, and then give us some context for the broader picture.
Yeah, for sure. So in Davidson County, closings, this number really stood out to me. The closings in October this past month compared to last year in Davidson County are down 36% and down 31% in Williamson County. That's number of transactions. The biggest thing that we talk about and that we have been saying for, I guess, literally years now on these videos, on these market updates, is that supply and demand is what dictates prices. This does not mean prices are going up or down. It really just depends on what supply and demand is. But what it means is other things that, this means essentially 4 out of every 10 buyers out there are not buying right now. So you have, realtors doing less transactions, mortgage companies doing less transactions, and there's ripple effects from that. But those are the numbers from October compared to last year. If we look at a rolling 3 months, the number is still high, not quite as high. However, we'll see what fourth quarter looks like after December for this rolling 3-month period. The rolling 3-month period ending, October, 27% down in Davidson County compared to the same period last year, and then 21% down in Williamson County. It's interesting, maybe I would just point out, if you watch these consistently, you've noticed as well, Williamson County, if somebody says, if you had to bet on the stronger real estate market, it's Williamson County. It appreciates at a higher rate. It typically takes less of a hit. It's like the market is just stronger in Williamson County. So worth pointing out. Moving on to year to date. So again, we've talked about this. My belief is this rolling 3-month period is where I'm giving most of my attention and weight, because, like you said, this could give you whiplash. This is almost like day trading. If I try to make decisions on a month to month, you got to look at a bigger time period than 3 month gives it. It's worth looking at year to date. We talk about that. However, there's been so much change. Rates have gone up. The Fed has increased rates over 300 basis points since the beginning of the year, right? So that 17% includes, what's the change been in the last 3 months for it to only be 17% year to date? But that's what it is in Davidson County. Transactions are down 17%. And then in Williamson County, only down 14%. Going to the prices, the median price for month, quarterly, and year to date, you see in Davidson County, it's 15 to 20%. And, if you look at year to date, it's 25, giving more weight to the last 3 months. We'll call it 20% in Williamson County. So about 15% price appreciation over the last 3 months compared to the same period last year. 15% in Davidson, about 20% in Williamson. And so year over year, still unsustainable appreciation rate.
Triple what would be almost quadruple. 4% would be sort of historical average. And I'm looking at what has the appreciation been like year over year for the last 5 months. Basically been 17, 13, 15, 16, 16. If we were in a price free fall, those appreciation rates would be 17, 13, 10, declining, because last year's growth would be catching up to this year's decline. We're pretty much staying on the same course that we were on last year, at least at this point.
So the big takeaway here isn't so much what does this data tell me, but what does this say compared to the general sense that I get out there? And that is that, maybe another way to say it would be, how do facts compare against fear? And the fear would be kind of like the stock market. I hear recession and the values go to zero, or they drop like really significantly and maybe never come back. And so what this tells me is transactions have dropped tremendously in October, even on the last 3 months. That's a huge drop in my opinion in the number of transactions. Everybody is feeling that. And yet prices are up 15% over last year. And then even year to date, they're up 20%. So just interesting. Looking at the inventory, again, we don't share this every podcast, but maybe somebody is tuning in for the first time. When we look at inventory, let's move on to inventory. In all price ranges and in any city in the U.S., we're going to look at a 6-month period. And the 6-month period is if there is a 6-month supply of homes, meaning if no other homes came on the market today, how long would it take for current buyer demand to basically buy all those homes? If it takes 6 months, that's a neutral market. That's where prices really aren't going up. They're not going down. They're staying pretty steady. And so we haven't been there in years. In fact, if you look at right now, even in the summer where inventory, there was a big uptick in inventory in the summer. There was a drop in demand because of interest rates. And even so, I'm confident that these numbers, that there's still less inventory today than there was 12 months ago. So it just really, if you follow these videos, you can really start to have confidence that prices are tied to supply and demand, not number of transactions. And so we could get into the nitty gritty of kind of why that is, but just that's an important thing to point out. So in all price ranges, Davidson Williamson County inventory has ticked up in October and November, but still historically way low.
Yeah, and I'm happy to, you're happy to sort of deep dive into stats for anybody that's really interested and would benefit from that. The short summary is you do have fewer buyers entering the market.
Yeah.
Interest rates probably impact that, but you also have dramatically fewer listings coming on the market. So that's what keeps the supply and demand. It's not like 2008, there was tons of listings available and no one to buy them. Now we don't have a lot of listings and we don't have a lot of buyers. So that balance is essentially kept the prices growing at the same rate as last year, because our balance is the same as it was last year in some way. So
that's right.
Speaking of rates, you watched the most recent report from Jerome Powell, correct? Yeah. Tell us a little bit about what you took away from that and how you think that may impact the market. Feel free to have a seat again if you'd like.
I like standing. Thank you.
You just like looking down on me, don't you?
I might even get my steps in back here.
So tell us about your takeaways from that and what you think the impact could be.
So my two takeaways were, he continues to make it really clear what their inflation target is, and that is 2%. We're over 5% now. So there's a ways to go. Anybody that's hoping that interest rates will come down in December, that's not going to happen. But that's a good number to know. If you watch I just appreciated hearing the source talk about policy and take questions and hear it for myself rather than reading it in the news, which can be helpful. But two takeaways were, number one, 2% is the inflation target, and they are absolutely committed to getting there. Fully committed to doing whatever it takes to get to a 2% target inflation rate. So there's time to go there. The second thing that was a big takeaway for me is that they are absolutely not going to prematurely slow the pace of rate increases. They are not going to do that. So, and these are my words, not his, essentially said, I would rather have rates, I would rather overcorrect and have to pull back, which they will, than to slow the rate hikes prematurely and basically drag this process out. So I don't know, it big picture, like when I think about my family and my friends, the analogy of surgery comes to my mind, and that is, this is going to be painful, but it's not forever. It's temporary. We've basically got to break the leg to put it back together. We're going to put you in a cast. There's going to be a recovery process. So be prepared for it. But it's temporary, and we have tools once we get the healing back to get you running again. Without going in a deep dive into politics and all the other stuff, I really try to take this stuff at face value, look at other information, and come up with my own opinions. So my hope is that they're willing to go all of 2023. Not my hope. My expectation is that they're willing to go all of 2023 and longer if they need. My hope is that all those data points that they look at, by the end of first quarter 2023, we're where we need to be, and they start pulling the interest rates back. But the interest rates so here's the other thing. Interest rates are going to go higher. We're over 7% on a 30-year fixed right now. They'll probably be at 8.5%, maybe even 9%. Ooh.
Feels a little jarring.
By the end of first quarter.
6% felt jarring a couple months ago.
Yeah.
But
so There's I don't know. There's a lot of opinions out there. So my expectation is that they'll go as long as they need to, but I don't think that they think they'll need to go through all of 2024. And my hope is that by the end of the first quarter, based on an aggressive rate hike in December, another one after that, and they can hit their target and then start pulling back interest rates and get things moving at a more sustainable pace, long term.
Yeah. And it's worth noting the mortgage rate and the Fed rate are not in lockstep. They're sort of indirectly connected.
Yeah.
What won't happen is they raise 0.75% on the Fed rate. The next day, interest rates are up 0.75%, sort of in lockstep. So there is,
right.
But they're connected enough that the trajectory of the Fed rate's going one way. Interest rates are going to trajectory probably follow that, but not always in a perfect mirror.
Totally. The other thing that's interesting is, so one question that we ask is, a couple questions. Number one, what are we telling our clients right now? Right? And so a lot of people, generally speaking, that aren't in the market, that they're not in the market, they'll ask, is it a good time to buy or sell? Because it's funny, because people that are in the market that have a motive to move, they don't ask that question. It's more like, hey, I need to move. Why don't you, let's talk about your options and process and numbers and can it work or not? So anyways.
Because what people sort of want to know is it such a good time to buy that I should disrupt my plans to make something happen? That's probably never a good enough time to buy.
95% of people, even if it was historically the best time, they're not going to do that anyway.
I wouldn't go back, a good time to sell, call it spring or late last year.
Yeah.
Great time to sell. Yeah. I wouldn't go back and do it.
No.
So, all right. So good time to buy or sell, not always relevant, but when you're talking to clients that actually have reason to move one way or the other, what are those conversations sounding like? How are you advising them?
Yeah.
What are the things that they need to be thinking through?
So a family comes to my mind that we met with just a couple of weeks ago, and we talked with them. And really, it's similar questions. So, is it good or bad? Is it a good time or bad time? It's fun to talk about, in a social setting or whatever, but it's so case by case. And so, what we talked about, I asked them, number one, tell me about why you're moving, what's going on. Okay, so school systems are involved, and space. Right? So that's common. We work with a lot of our clients are moved because, their kids are getting older, and that means they'd like more space, and a lot of times they want a different school system. So that was their situation. The second thing is, can they afford it? So we talked about interest rates. Should they buy now because they own a home? Should they buy now? Should they wait? And so the second thing is, can they afford it at current interest rates? And the answer is yes, they can. So then it's well, should we wait? And we talked about this in the last podcast and actually thinking about this saying that's been going around, which is marry the house, date the rate. When interest rates were first going up, I didn't like that. I still don't like the phrase, but I think it does make more sense now, because of the way things are going and how aggressive the Fed is needing to be, and the almost certainty that they will scale back once they hit their target inflation rate. So we just talked about, number one, how important is this space in school? Mm-hmm. If it's hey, we got plenty of time and we're actually fine here, and you've got a 3.5% 30-year fixed, then that's worth considering. And if it's me, frankly, I'd probably stay where I'm at. If it's in a situation where it's there's no chance I'm going to put my kids in that school, and every day I come home, we're just busting at the seams. I'm going to do whatever it takes. And so the question is, can I afford it? And then for me, and what we talked about is, yes, they can afford it. And if interest rates go down in a year, then they can refinance. Mm-hmm. And if they don't, then holding off wouldn't have mattered.
Right.
I think that, to me, just thinking through the fast forward 12 months, if interest rates go down, I can refinance. And if they didn't, it wouldn't have mattered to hold off anyway, right? So then go ahead and pull the trigger. The other thing is, not these folks, but a fear could be, I don't want to move and go into this other house. And then again, not looking at the facts and history, but going, I don't want to pay for this house and then prices plummet. Mm-hmm. I wouldn't either. And I can totally relate to fear kind of saying that's what's going to happen. However, if I own my home, if that happens there, it's going to happen here. In other words, if I don't move, the home that I'm in and all this equity that I currently have, if that truly happens, I'm not going to have any equity anyways. Mm-hmm. Then I might have to go come up with the cash for down payment or whatever. So it's all case by case, but that's what the conversations sound like. Mm-hmm.
Buying and selling in the same market. That's what you're
buying and selling in the same market. And I do think, and I think that this would reflect this, is that it has to be pretty special motivation to go from a 3.5% rate to a 7% rate, mm-hmm. right? So there's that. Also leads to another question, more broad question, and that would be like, what is the opportunity? My belief is that there's opportunity in any market, and I believe that the opportunity right now for these folks in particular and other people is that compared to 5 months ago and the last, call it 2 years up until the last few months, especially if you had a home to sell. Home sale contingencies were essentially, not totally, but essentially non-existent for the last several years. And so the opportunity is now, it's several things, and it's really on the buy side. We're negotiating home sale contingencies. We're negotiating closing costs we paid. We've got time to inspect it. So now I can make sure I'm getting the right home. It's in the right condition, right price, right terms, all that. I have breathing room. It's not so frantic. And if, depending on your patience and your willingness, go ahead and make some lowball offers and see what happens, right?
Worst they can say is no.
Worst they can say is no.
I mean, you obviously have to be there's got to be a reasonability to it. But if you're thinking strategically and want to genuinely have a conversation about, hey, where can we find the right price for this property?
Yeah.
Like, you're not competing with 10 other offers going,
right, how many
millions of dollars over do I have to go on this $300,000 house just to get it?
Which I think it's another difference, which I think is an opportunity of this market, which is there's an opportunity to buy something where I can have an appraisal contingency, so I don't have to deplete all my cash. Maybe I only, whether you're putting, 3% down or 20% down or whatever, that's all I'm going to need. Mm-hmm. I'm not going to have to deplete all these cash reserves to throw at it. So
yeah, and there is opportunity to maybe, in some regards, like create your own deal, create a situation that's comfortable. We're not yet in a bargain basement scenario. Prices generally, homes are selling for roughly their list price generally. So it's not, hey, these 460
the homes that are selling.
Yeah, but like this 465 median, those are not listed at 550, selling 100, under asking price typically. They're listed at maybe 470 median, and then sold for 465. And you may have some closing costs or whatever, but usually right now, the price you see is the price you're going to get, roughly, which is a pretty welcome change from several months ago, where it's like the price you see, that's the starting price of the auction that you decided to show up for.
No, that's exactly right.
So, all right. So there is opportunity. And like you said, with this family, one of the opportunities is to actually sit and like put a plan together, which is really helpful, and I think most people benefit from. So any last thoughts on the past month or the past several months before we wrap this one up, Alex?
No last thoughts on the market. I would just say thanks for tuning in. This has been a little bit of a lengthy podcast, but I feel like there's been a lot of information to go over. So I hope it's been valuable to you. As always, if you want to chat about your situation and how we might be able to help you buy, sell, or invest in real estate, we'd love to talk. And appreciate you bringing a question and helping us out.
All right. See you next time, Alex.
See you guys.